Hello, this is Brian Shannon from AlphaTrends.net. Today is Wednesday, the 21st of May, 2008. The market's closed, and we had a resumption of selling here again today. The S&P 500 lost $2.65, or about 1.8%. And you can see here that we're back below this trend line and coming down towards the important level near 138.5 or so. The 200-day moving average is declining, as I've been pointing out, and that always gives us reason for concern on the longer-term time frames, and that's why I've been suggesting that you have to be very defensive and cautious in this area around this level. This market has rallied up towards that prior important level of support from last year on diminishing volume, and that again gives us reason for concern, and you have to watch very carefully when it gets to those important levels. As far as the retracement levels go here, from last year's highs to the lows that we saw this year, the market came close to the 2/3 retracement, but didn't quite make it up to that level. Looking at a 30-minute time frame yesterday, what I had mentioned actually the day before yesterday was that if we were to get below 142, that would give us reason for concern and time to become much more defensive. Well, now that we're back below that 142 level, the market actually rallied up towards that level in here today, almost hitting it exactly right on also the location of that 5-day moving average, and that's where the sellers were once again. So 142 was clearly the important level, as I was stressing, and we did find resistance there today and then a lower high, and then the market gave way here. And if you were short, I just can't resist not drawing the smiley face, because the guy that always tells me that I'm too bearish actually emailed me yesterday and said that once again I was being too bearish. So he hates it when I make these smiley faces, and I don't appreciate his emails. So here we're back to even. So the S&P 500, as I said, breaking below that support level here, I thought that 139.5 to 140 would be where it goes, and now we're down towards that level, and that's still, we've got no signs of stability in here. As you can see, we finished very close to the lows for the day, so there's no reason to be looking for a buy in here. This market's going to need to heal itself if it is going to give us a reason to buy. But right now, with a declining 5-day moving average and a clear pattern of lower highs and lower lows, there's no reason to be looking for a place to buy. If you're looking for buys, then you're better off just on the sidelines in cash, waiting for a better opportunity. Now we have to look to the downside at about 138.40. That was an important level, if you remember before, as far as support went. So 138.40, and as far as being bullish again, I don't think that's part of the picture for tomorrow, but it's going to have to at least get back above 141, and that's too far away that I just don't think it's likely to give us any reason to buy here. So as I said yesterday, the shorter term lower highs and lower lows means that we have to be very defensive. The semiconductors, these guys ran up just above their 200-day moving average. They failed. I said, we wanted to be very defensive in there the last couple days, and still no reason to be looking for a buy. Not yet. That it could turn around. The biggest reason for concern, in my mind, is this $73 level on the IWM. This is the key level that a lot of times when you see a key level very widely watched like this, it'll rally up above that $73 level, get people to become very confident, and then set the trap for lower prices. Now, we can't call this a failed move yet. I said that basically we wanted to see $72.75 to $73 hold on a closing basis. It closed at $72.65, so that clearly is reason for concern. We've got the declining 200-day moving average that was tested, and that's where we found sellers. Those sellers were also near the prior important level here. So it's not always just one exact precise number, but a widely watched number like that will often give when it breaks above it, everyone will start breathing easier, thinking it's it's okay to be long once again. But defense plays the game, and there's been some great trades to the long side in the Russell 2000 lately. On the positive side, we've got this trend line here that comes into play at about $72 a share, and then we've got the low right here at about 71. which is where I think the 50-day moving average will catch up to this market if we continue lower here over the next couple of days. But clearly just a lot of reasons, with these lower highs and lower lows. And you can see the Russell actually was strong most of the day. It had a real strong start, but couldn't hold on to those gains. And now we see that this important level of 73, got broken hard in here, acted as resistance right now. I think that you really want to be cautious in the Russell. We've got a declining 5-day moving average. You're going to have to see it get back around 73.50 before you can really start thinking that it makes sense to be long in this group once again. Don't listen to people on TV saying the Russell is strong or whatever. It has been stronger, but now it's breaking down, and that's what pays. Is not what it did yesterday or last week or last month, but what's the trend for now? And the short-term trend is clearly lower. We've broken some important support in here, and it could continue to fall down towards that $71 level. So got to be very careful in there. The weakest group is obviously these financials. Still looks like they're heading for a test of 24.40. That's been an important level back here in late March, in mid-April. Breaking below that, then it's very possible that we could see the Bear Stearns lows tested in here. And if that's to happen, then the possibility of a larger breakdown in the market becomes a possibility as well. So got to be very careful in here. We've had a lot of conflicting signals from multiple time frames, and as the name of my book is technical analysis using multiple time frames and looking for alignment of trend. And alignment of trend, well, you have that in the financials. You have a downtrend here, and you have a downtrend in the shorter term time frames as well. So these trends are aligned. What you don't want to see is conflicting messages, and that's what we have been seeing in, for instance, the the Nasdaq 100, where the weekly time frame is still not as bad as the other groups, but I was just using that because as a lead-in to the Nasdaq 100. But this market came up to the 2/3 retracement level of the highs from back in October to the lows we saw back here in March. And that's where we've got this selling coming in now. The daily time frame, where are we? Right back down to this 200-day moving average, and that's going to be continue to be an important level. That is the the 200-day moving average and the $48 level. As I said in here, that basically breaking below that 49.60 level was where this market. I said that Monday that if the market actually, if the market could get back up to 49.60, what I said yesterday was, then you want to be very cautious because it will be meeting this prior level of support and the 5-day moving average. Today it came right up to that 5-day moving average, that in that 49.60 level, and then that's where the sellers indeed did show up. And we can see it here. The high was 49.60 exactly. That's where the sellers were waiting in the wings, and from there, the market made this lower low and then really broke down. As I said yesterday, I thought that breaking the 49 level could lead to a quick move to the $48 area, and we had this market come down pretty much right on the money to that $48 level. So now we've got a declining 5-day moving average. We've got lower highs and lower lows. We've got this broken trend line in here on the 30-minute time frame, and that means we've got to be very cautious in here. It's above the 200-day moving average, but it doesn't mean that this 200-day moving average will continue to hold this market up. It's possible that we could see a further retracement down towards the 46.5 level, which is where the 50-day moving average is. So in other words, all in all, we've got some damage done in this market. I think it shows the overall nervousness. We've got $133 a barrel dollars for a barrel of oil, and I think it's really starting to reach the breaking point for a lot of people looking at equities, saying, does it really make sense to own them? And it has it, when you look at oil and the surge in there, the market's not supposed to go up with oil going up, but it's, the only thing that pays is price and what you see and what you trade. You have to trade what you see and forget about those relationships that are supposed to be there, but instead, not necessarily forget about them, but be aware of them. And when you see those relationships kind of diverging, not doing what they're quote unquote supposed to do, then it means just become very cautious and quick on the exit button, because it's truly a shorter term trader's market in here right now until we get some clarity and confirmation of trend from multiple time frames. When we have this trend confusion, you've got to just take it easy or be super aggressive.